welcome to the stage Steffen Meister, partner and executive chairman of the board of directors at the Partners Group, Noel Quinn, Group Chief Executive of HSBC, and Rohit Sipahimalani, Chief Investment Officer of Temasek, for a conversation with Bloomberg's Jacqueline Simmons.
So I want to say that even in years that are far calmer than the one we're in now, striking a balance between government regulation and entrepreneurial freedom, fostering business growth, sounds at best Herculean. But I'd like to start with Noel. So 2 weeks ago, when it was announced that you were stepping down as Chief Executive Officer after 37 years at the bank, of which 5 as CEO, someone who covers the bank very closely said to me, Noel Quinn has inarguably the hardest job in finance. The hardest job because you're basically, navigating an Asia-focused, UK-listed bank through tensions between Washington and Beijing. So could you reflect a little bit about stepping back in this specific moment for geopolitics? And do you think your successor is going to have a tougher time doing the job that you've been doing?
Well, listen, firstly, I've been absolutely fortunate to have worked for HSBC for 37 years, and it was a privilege being the CEO of HSBC. As the CEO of HSBC, 37 years ago, I would never have dreamt at all that I could have achieved CEO of this bank. This bank has a great heritage, 159 years of heritage, and it has been involved in international trade from day one. We opened in Hong Kong. 1 month later, we were in Shanghai. 3 months later, we were in the UK, in London. And within 10 years, we were around the world, in the Middle East, in the Americas, in Europe. So internationalism is at the heart of HSBC, and internationalism goes through many cycles of challenges and opportunity. And at times there are both challenges and opportunity, and I think we're in one of those times at the moment. So we've navigated complex international politics, complex international economics for 159 years. If you want to be CEO of a bank, and an international bank, you have to get used to dealing with complexity and turning complexity into relative simplicity for our people. 200,000 people need to serve clients, even if the world is complex.
Mm-hmm. So it sounds like you're saying your successor is going to have a tougher time.
Any CEO of any international bank is going to have to deal with complexity on the international scene. But for me, it's been an absolute privilege, and I've enjoyed every moment of the last 5 years. You cannot do this job if you don't enjoy it.
I want to just touch on sort of one of the themes of the panel, which is entrepreneurship.
Sure.
And zoom in a little bit just on the purchase by HSBC of SVP, Silicon Valley Bank, in the UK. It's obviously bought in a distressed moment. SVB was in the process of collapsing. SVB was founded to fund entrepreneurs, and you remind people often that HSBC was created to bank entrepreneurs. And so how do you maintain the spirit of entrepreneurship when absorbing a very tech and entrepreneur business like SVB into a behemoth that is HSBC?
Yeah. Well, when I was living in Hong Kong, I read the very first board minutes, the actual minute book, the very first board meeting of HSBC. And in paragraph 2 and paragraph 3 of those board minutes was the purpose for it being created. It was created by entrepreneurs, not bankers, to serve entrepreneurs and entrepreneurs who wanted to trade internationally. And that purpose of 159 years ago still exists today. And what we are today is a function of all of the clients that we have banked over the past 159 years. And in Silicon Valley Bank UK, on that Friday when it went into difficulty, I saw an opportunity to acquire a bank that serves entrepreneurs in the innovation sector, in life sciences, in technology, in climate tech. And why wouldn't I be interested in a bank like that? So this was very much a strategic decision. When I called the Bank of England on the Saturday, who had taken that bank into administration, I said, I have a real strategic interest in having a look at it, but I don't know the financials. What was interesting that weekend, we mobilized over 100 people to have a look that Saturday, Sunday. We didn't write one paper, not one PowerPoint presentation. We looked at the data room, we had conversations, we spent our time analyzing the business, and everything strategically stood up, and financially it stood up. And we made the decision that weekend, without any bureaucracy, just good old-fashioned commercial decision-making, and it was both a strategic opportunity and a financial opportunity. And by Monday morning, we bought the business, and it's been a great acquisition for us. And we've now decided to build the business globally. We're taking our ability to bank entrepreneurs in the early stages, in life sciences, in technology, and now want to help them go on their global journey. It was a great entrepreneurial move.
I want to come back to that, but I also want to touch on Temasek, which is also dealing with two big markets, two big countries that are at loggerheads. So excluding Singapore, your exposure to the US and to China are about equal, 22% for China, about 21% for the US. How are you adjusting your strategy around geopolitics?
So look, where US and China are concerned, they're both the first and second largest economy in the world, and we continue to find opportunities in both markets. Now, however, as you pointed out, I mean, the geopolitical world we are in is leading to increasing nationalism, protectionism, and we have to factor that in as we look at investment opportunities. I would sort of bucket about the three broad things that we consider in that context. One is that we have a preference for investing in companies that have access to large domestic markets and that are relatively self-sufficient within an economic bloc or a political bloc in terms of supply chain technology, et cetera. And there are many such opportunities in the US and in China which fulfill that. So in the US, it would be cloud services companies, actually almost any services company in the US. In China, it would be a lot of consumer brands targeted at the Chinese market. So there are opportunities there, and we continue to look at those. The second thing is that in this quest for national security, we're going to have redundant supply chains. I think it was mentioned last panel also. But a lot of that will be at higher cost locations, and cost structures will go up, and you're going to have a high inflationary environment as a result. So it becomes very important for us to invest in companies which have pricing power. And then on balance, more of the portfolio needs to be stuff that will actually benefit in a higher inflation environment. So things like commodities, things like infrastructure, compared to the last decade. And then finally, I would say, even as you look at, with governments trying to exercise industrial muscle, spending more on fiscal, there's going to be more and more government borrowing. So in this decade, you will see higher real rates compared to the last decade. And so therefore, there's a preference towards companies with stronger cash flows. And earlier stage VC companies, which require a lot of capital, will struggle more compared to the last decade. So those are shifts we are making, but the important thing is balance, right? When I say, it's relative to the last decade, we want to be biased more in these areas. But ultimately, we've got to be balanced because we don't know what the world will be like. I'm saying it's going to be a high inflation environment. It probably will be for the next 3 years. But in 5 to 7 years, depending on how AI progresses, productivity from that could be a disinflationary force. So I don't know where things could end up. So it's important for us always to have balance in the portfolio, but trying to adjust to the geopolitical realities in the context I mentioned.
Okay. And Steffen, we talked earlier just about the US market, your biggest market, and how you can't really talk about that market without touching on what's happening in Europe. And so I wondered if you could just tell us a little bit of what you're looking at specifically from policy leaders in those markets, and especially now that they're coming up against pretty big elections.
Yeah, happy to do so. I guess I made that comment, in the context of this maybe unusual situation that we are a European headquartered business, but our biggest market is the US. And often the question is, well, is that because the US is so much more attractive? And the answer is, no, that's actually not the case. It's simply a bigger market, for the reasons you mentioned. We look for exactly the same ingredients for a good business, which is an ecosystem. We are a thematic investor where we see change, where we see transformation that brings the potential, the tailwind, where we can develop businesses at 10, 15% growth rates. And we find them actually equally in the US and in Europe, but just Europe is a bit smaller. And maybe give you an example here, the way we think about that. Since about 10 years, we look at the reconfiguration of pharmaceutical supply chains. That's with a change from the chemical products, the small molecules, to biologics. That comes with a completely different supply chain. And so there's all kind of businesses from the discovery stage to the in vitro testing to the FDA process, commercialization and distribution that completely changes. And so in these areas, we try to understand what are the businesses that have maybe the best outlook for the future that we can develop. I want to make a comment about Europe, because implicitly, I think a part of the question is always, does Europe really have these interesting businesses? Everything seems to happen in the US these days. And I think that's a bit of misperception, I have to say, And I often like to use the example of chips and the semiconductor business or industry. This is seen as a very US or maybe also Asian kind of, dominated business. But if you think about a supply chain, you'll be surprised. It's not only the largest company, the most successful company in producing the machinery for the extreme UV lithography manufacturing, that is a Dutch. But then also, if you look at what is the laser company that delivers actually to ASML, that's a German company, Trumpf. What is the optical devices company that delivers to the laser company, that Zeiss is a German company. And who provides these clean environments, who provides the vacuum valve technology for these rooms? That's VAT in Switzerland, it's a Swiss company. It was actually a portfolio company of ours for many years. So I think there's a bit of misperception because maybe you don't see so many of these global champions anymore in Europe compared to maybe 10, 15 years ago. But there's an amazing actually range in technology, in pharmaceuticals, in digital services of leaders, specialist leaders in a space, very often, actually leading over their US peers.
Right. Right. They're overlooked, but again, as we discussed, how do they get to the scale and sort of brand recognition that the US and Asia has done? That's sort of the question in bridging that gap. So I'm going to actually skip forward to a question I wanted to ask you about innovation. We talked about the tsunami of innovation being both a challenge and an opportunity, and I hope Rohit and Noel can both come in on this question too. But I wonder, we talked about how a business that you buy today is going to look completely different to one in 8 years because of the pace and transformation of technology. What does this pace in AI and technology mean for investments, for M&A, and how might it change the life cycle of investments?
Yeah. Well, look, the starting point, I think, is our hypothesis that what we're seeing at the moment is a bit of a, I would say, next phase of this first digitization that started 25 years ago. 25 years ago, we saw two events. That's internet accessibility and affordability of computation power. Okay, that led to middle market businesses having servers in their basement and software, and they got connected. Then we had all our devices getting into that platform. And so that developed over the last 25 years a totally different economy where businesses have fundamentally changed. We're seeing something very similar happening now with AI and with computation power as a service. But we think the big difference is this is going to be like 10, 15 years. Because it's much more digital, there's much less need to build the actual infrastructure that last time around. So if you think there's a merits in that hypothesis that our economic transformation will be done in about 10 to 15 years from now, you buy a business, a private markets firm, like ourselves, you own it for 6, 7 years, that means that more than half of that economic transformation is over. So you need, when you buy a business, have a very clear hypothesis of what will that ecosystem look like in 10 to 15 years' time. I say hypothesis because no one knows. There's so much uncertainty over so many things, but you need to have a direction. And you need to define for a business that you buy today a winning business model and a clear path. And you have to literally, on day one, you have to actually get on that journey. Because if you want to transform the business over the next 5 to 6, 7 years, you have to start right now. So the business we are in my opinion, has changed fundamentally compared to 10, 15 years ago, when financial investors, I think, were doing quite well just with the leverage market and just basically being passive financial investors. The next 10, 15 years will be a much more industrial approach, where you really develop these businesses in a very, very active way, very hands-on. Think of it much more like what family businesses would do. Plenty of them in this region here.
Rohit, do you think that AI shortens or lengthens the life cycle of investments that you look at?
So, I think every investment that we look at right now, and for every company in our portfolio, we have to ask the question, what is going to be the impact on AI? One is that, is it going to disrupt the business fundamentally? Is it just going to be an enabler which would help take out costs? Would it allow you to sort of tap customers better? What's going to be the impact? It's not an easy answer. We actually, at this point, forming cross-functional groups within the organization to look at that. But that's going to be fairly critical. And there are going to be some businesses that are not going to be disrupted, but definitely AI will be an enabler in almost every business. So, for example, if you invest in a hospital in India, now AI is not going to hospitals are not going to be done away with. Now, how some of them operate, how can they be more productive? Obviously, it's going to have an impact. So we've got to think about it from that lens. On the other hand, if you look at something like a call center business, you know that it's ripe for disruption. So it is something you have to look at. I don't think, typically when we're investing, particularly in the private markets, you have to take at least a 3 to 5 year horizon, sometimes longer. So I think it's tough to say that, look, I'll get out quickly before that change happens. That's a very difficult mindset to have. Right. So you've got to look at, what is the risk, what is the opportunity, and what can you do along the way?
Right. Can I come back to you, Noel, just on the SVB? I'm thinking more about sort of regulation, and you mentioned that this was able, over a weekend, you didn't need a lot of wind up, you just got it done. And I just wonder, having sort of navigated that deal, how you were weighing up sort of the risk rewards of that, and what are actually the takeaways or lessons that might be applied to your industry going forward?
Well, take that weekend as an example. It was a phenomenal example of very strong engagement with the regulators. And they had a very clear plan of what they wanted to do if a bank got into trouble in the UK. They had a very clear resolution plan. They invoked it on the Friday. They operated it the Saturday, Sunday, with the ambition of coming out on the Monday morning with a solution. And the Bank of England did a phenomenal job in handling that. And if I spoke to them 20 times that weekend, I probably spoke to them 50 times. And it was just good old-fashioned open dialogue, trying to solve a problem between a bank and a regulator. So dialogue is always a great thing to have, and that weekend we had a lot. And we had a common purpose, find a solution, and it was strategically important for us. If I can come back to AI, because that touches on regulation as well. Look, AI is a hugely powerful capability. We are embracing it. But we're cognizant of the risk. So there, you've got to be cognizant of the regulatory risk, of bias, of unintended consequences, of poor data leading to poor output. So you do have to tread carefully whilst embracing. And we're doing both. We processed last year over $500 trillion of payments digitally, globally, on behalf of our clients. We're the second largest payments processor in the world as an international bank. We are using AI on that to help us understand the patterns of behavior, the risks in that payment traffic, the opportunities in that payment traffic. But in terms of fulfilling our regulatory obligations for financial crime compliance, AML, sanctions, we're using AI because it's enabling us to gain insight that we can't get through traditional algorithms. Now, one other thing on AI, whilst be cognizant of the risks, be excited by the opportunity. And for me, AI, I think, is, put simply, an acceleration of learning. It's an acceleration of knowledge. Its ability to get your hands on knowledge and learning faster than you're otherwise able to do. And I think we will find it will lead to breakthrough opportunities in my view, in life sciences. The research and development cycle on cures to medical conditions will be accelerated with the power of AI. And I think we should be cognizant of the risk, but excited by the opportunities. And I believe the world will be a different world in 10 and 15 years because of AI, and a positively different world.
Yeah, I want to talk about it because we don't have an enormous amount of time. I just want to be remiss to not let the audience know that you are able to ask questions using the QR code that was provided. But you know, there's a different kind of risk I want to hit on before we talk about the Middle East. There's a lot of news right now about tariffs, if it's EVs or the EU, for instance, imposing levies on carbon-intensive imports. Are these examples of, you know, good/necessary regulation, or is this just moving us further into the, you know, protectionism camp?
Well, listen, fundamentally, we're the largest trade bank in the world. We fundamentally believe in free trade. So for me, free trade, global trade has created the world of today and helped the world of today become a stronger economic world than it has been or was 30, 40 years ago. So we believe in that. In terms of carbon trading systems, I personally would rather put my faith in voluntary carbon markets and trying to create a voluntary carbon market ecosystem. And I look at that as an ability to attract investors into projects that are requiring revenue from non-traditional sources and can crowd in additional private sector revenue to provide carbon solutions, development of technologies, development of nature. That, for me, I think, is the more empowering version of carbon pricing. It's creating a carbon investment opportunity through a voluntary carbon offset market with good regulation, good legitimacy, good validation. So it's not avoiding the issue, but that can crowd in investment alongside traditional forms of investment, bank debt, private equity, public equity, concessionary finance. It can crowd in another source of investment into some projects that need that investment source.
Okay, so with the minutes we have, I want to just ask, Steffen, you have about 1,000 employees in the region through your portfolio companies that you're invested in, and you likened your presence in the Middle East to what it was like in APAC 2 decades ago. I think you mentioned Singapore specifically. And I just wondered, you know, how are you thinking about both about this region as a place of investment, and is there a gap to be filled by private equity and firms like yours?
Yeah, I guess the comparison I drew is the following. You know, when we started to be active in Asia about 25 years ago, so not super early, but probably for private market, you know, comparisons relatively early. And we have chosen Singapore in 2004 actually as our hub in Asia. And that was not necessarily for the reason that Singapore in itself was actually such a relevant economy, but we clearly saw Singapore as a growing gateway to Northern Asia, to Southeast Asia. And I think in a little bit of similar way, you know, we see the GCC, Qatar, you know, as a gateway to something that is bigger than the GCC, you know, including India, the global south. And in that context, we also see that our portfolio companies, a bit like 25 years ago in Asia, become more and more relevant here. You know, we have in Qatar about 300 employees in our portfolio companies. You know, we just grow literally by the month actually here. And this is simply because, you know, it is attractive for our portfolio companies. And that's often because also of indirect activities out of Qatar or out of the GCC. What is the role of private market? You know, I think it will be a very natural development. I'm not so sure whether, you know, there is a necessity for instance, specific schemes to attract money very quickly or for certain things. I think what happens is usually these things take care of themselves automatically if there is a market. This is what happened in Asia. This is what I see with our portfolio companies here in the region. You know, as relevance of certain sectors, this is the consumer sector here, that's certainly energy technology for sure, but it's also education actually, you know, which is a big thing in GCC and Qatar. As these sectors grow, I mean, portfolio companies come here and money actually flows into the region. So I think it's a very natural process. In that sense, I'm not sure whether there's a gap. I think it's just a natural process, you know, which takes a little more time. My gut feeling is it will be a little bit faster than in Asia 25 years ago.
And Noel, this is the 70th anniversary of HSBC operating in Qatar. And you're the largest international bank in the region.
Yep.
So I'm just curious, how does building a bank in the Middle East differ from other parts of the world?
I think there are core parts of building a business. First, be committed long-term to a market and work through the cycles, the good cycles, the bad cycles. Don't be in and out. So that's a philosophy I think that's important. Build long-term relationships. It's not about doing deals or doing transactions. It's about building relationships, understanding each other, and then finding ways to help and do deals then flow as a consequence of a relationship. And I think if there's one thing I've learned in my 37 years at HSBC, and I've said many times to frontline bankers, your job is to build relationships and then transactions will follow. Your job isn't to do transactions. And I think in markets like Asia, the Middle East, it very much is about having a consistent presence, good times and bad times, building relationships, building empathy and understanding, and the rest looks after itself.
And one final question, just maybe to the panel, and maybe start with Rohit, just on that point. But how are Middle East sovereign fund flows shaping discussions around global investments and regulation?
Well, look, it's a big force. You have about almost $4 trillion of sovereign wealth funds from this region. And that capital is investing over $100 billion a year globally. So it clearly is a big force. You know, for us, we find it an opportunity to sort of partner with the funds here as we look at opportunities elsewhere. It's interesting that I do find that there's been a slight change with some of the countries here now as they're investing overseas. They're also looking as to what their investments could bring back to the region for the development of the region, which was, I guess, different from what it was earlier. So I would say it is bringing the Middle East a lot more into focus globally, but it's also making people alive to the opportunities out here. So I would say from a Singapore perspective or Temasek perspective, whereas I don't think our capital in itself can add to very much out here, but our portfolio companies that have something to bring in the transformation of this region. So we have a big port company, we've got banks like DBS Bank, we've got real estate companies, we've got power utilities, waste to power companies. All those companies have something to bring to the region. And they're all seeing a big opportunity out here. And it's for people like us, so now we're getting more conscious and encouraging these companies to come and saying, we'll invest alongside you. Because I don't think for us, investing just on our own, just as a financial investor, I don't think we're bringing that much and we can't be that competitive. But it has brought the region into focus. Just the money that's going out from here is also bringing the region into focus in reverse.
And just very quickly, because I know you've worked with, or you've been across from one of the Abu Dhabi funds, and I wonder, what can you tell us just how you do work with counterparts, from the Middle East, and in terms of sharing expertise and information?
Well, since we're both investing globally, I mean, there's the situations, for example, in India, there was a hospital investment we did, and we had 59%, we didn't need to own more than 51. We syndicated part of that out, and there were funds out here that came and sort of invested alongside us. Similarly, in Asia, right now, for a lot of funds here are beginning to look more at Asia. And places like China, we have actually been there around for 20 years. So we find some of these funds want to work with us as we look at opportunities out there. So I think it's a good partnership. We both benefit from engaging with each other. And then in some areas, particularly in areas like sports and gaming and a few other areas where they've been investing in the West, those are areas we've not invested in the past. And so if there are opportunities and they come to us, I mean, those we can look at seriously too.
Okay, unfortunately, we're just right down to the wire, but I want to just end where I started, again with Noel. You said you're going to pursue a portfolio career, looking at multiple roles at different companies after a period of R&R. And where will the Middle East fit in your next chapter?
Well, listen, I've got huge affection for the Middle East, huge affection for Asia. I've been an international banker for ages, so I hope to have some engagement continuing going forward. I've got to keep this going, and and maybe slow down on using the body so much with too much international travel. But I'm looking forward to a bit of rest and relaxation, and then re-engaging on a variety of topics that I'll be involved in going forward. But it's, I love the Middle East, and I love international business. It's been 37 years of my life.
Great. No, that note, thank you. And thank you, panel.
Thank you.